It's Wednesday, 10th of December, 2025. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every weekday. All right, let's jump straight in. The cost of money. India's markets closed Tuesday with a noticeable downturn.
Yep, the benchmark index saw a cut of nearly 0.5%.
So not a total panic, but it definitely signals some caution out there. What was really driving that selling pressure?
It was a classic risk-off signal. And the core driver was foreign portfolio investors. They were acting as net sellers.
Okay.
But the story isn't just about the main index. If you look at the broader markets, especially mid and small caps, that's where we saw some significant erosion.
And when those smaller stocks suffer, it tells you something about the market's mood, right?
Exactly. It tells you the overall appetite for risk is, momentarily drying up, probably fueled by those mixed global cues and, of course, everyone waiting on the Fed.
That cautionary mood it was crystal clear in the debt markets, a serious yield shock.
A huge one.
You had state-run heavyweights like Power Finance Company and SI Davy just walking away from the table.
They withdrew major bond issuances. We're
Right.
talking about a massive amount of capital they just rejected.
Why? Why turn that down?
They simply refused to pay the sticker price. Investors were demanding yields that are about 15 to 17 basis points higher than just a couple of weeks ago.
Wow.
It's a sudden, pretty massive shock to the cost of borrowing. It signals that even though the RBI has been cutting rates, the market is pricing in immense supply pressure.
So investors are just demanding higher compensation for the risk.
They see the supply, they smell the risk, and they want to be paid for it. Simple as that.
Okay, so this seems like a contradiction. We have infrastructure giants who can't raise debt cheaply.
Right.
And yet the rupee actually strengthened against the US dollar yesterday. How does that work if foreign investors are selling stocks?
It does sound counterintuitive, doesn't it? And that's really where the RBI's own strategy comes into play. Governor Sanjay Malhotra is focused on making the rate cuts effective. He's pushing banks, and pushing them hard, to use technology to trim their intermediation costs.
Okay, let's unpack that term. Intermediation costs. What are we actually talking about?
Think of it as the friction in the system. It's all the operating expenses, the inefficiencies, the margin that banks add before they pass a rate cut on to, you or a business.
So it's the plumbing of the financial system.
Exactly, the plumbing. If the plumbing is clogged, the RBI can cut rates all at once, but cheaper credit doesn't actually reach anyone. By trimming those costs, the rate cuts become potent.
And that supports real growth, which is ultimately good for the currency.
Precisely. It's a long-term bullish signal for the currency, even if the stock market is taking a short-term breather.
Got it. So if foreign capital is flowing out of the broader market, where are the targeted bets being placed?
Looking at the November flows, it's very strategic. Energy and telecom, those sectors continue to pull in the highest foreign flows.
That makes sense.
Yeah.
Foundational infrastructure.
Right. It shows long-term confidence in India's power transition and its digitalization. On the flip side, sectors like FMCG and automobiles saw the biggest outflows.
And that's not a vote of no confidence.
Not necessarily. It looks more like straightforward profit booking. Investors just taking some money off the table after a really good run in those high-consumption stocks.
Let's pivot from financial flows to, corporate turbulence. I'm talking about the massive operational collapse at Indigo.
A phenomenal setback. The government actually ordered the airline to slash its flight schedule by 10%.
10%. For the market leader, that's a huge capacity reduction.
It is, and the reason is almost embarrassingly simple. A failure in basic human resource management.
They just didn't have enough pilots.
Not enough pilots to comply with the new and very essential rest rules. So you got what sources are calling pandemonium. Over 5,000 flights canceled in a week.
And the ripple effect is immediate. Companies postponing travel, which hits the hospitality sector hard.
A complete logistics nightmare. Now, Indigo says it'll normalize operations next week, but the headache is just beginning for them. It's now a regulatory issue.
How so?
Well, when the company with over 60% of the market fails that dramatically, the Competition Commission of India starts asking questions.
About abuse of market dominance.
Exactly. The argument is, when the top player collapses, thousands of passengers are stranded, held hostage to competitor pricing. That's a classic anti-competitive scenario the regulator has to look into.
So it's elevated from a pilot shortage to a question of fair play.
It's a much bigger problem for them now.
Speaking of enormous scale, let's move from collapse to confidence. Big tech is placing some unprecedented bets on India.
I mean, unprecedented is the right word. We saw an eye-watering commitment from Microsoft's CEO, Satya Nadella.
The largest investment in Asia.
$17.5 billion, all specifically earmarked for extending AI and cloud infrastructure in India.
That kind of investment, it signals that India is seen not just as a market, but as a strategic pillar for the future of AI.
It's transformative. And it's not just software. India is physically placing itself on the global semiconductor map.
With Tata Electronics facility in Gujarat.
That's the one. They're targeting production of 50,000 wafers a month by mid-2027. That is a crucial piece of the Make in India push, a real move to establish some resilience in the global tech supply chain.
Let's do a quick check on the consumer pulse. Unilever seems to be setting a pretty high bar for its Indian unit, HUL.
Yeah, the global CEO wants HUL to grow at least in line with India's overall GDP, moving past this recent period of, mid-single-digit expansion.
So that's a big vote of confidence in a consumer demand recovery.
A very strong one. It suggests they expect demand to accelerate significantly.
Meanwhile, in the telecom sector, it looks like they're getting ready for their own earnings boost. What's happening with pricing?
All the major players, except for Reliance Jio, have started subtly revising prices on some prepaid plans.
And that's the canary in the coal mine.
It is. This is widely seen as the precursor to a big sector-wide tariff hike in the next few weeks. They're looking to lift profit margins.
So we should all expect our mobile bills to go up soon.
I think that's a safe bet.
All right, shifting to the global picture, the entire financial world is basically just watching the U.S. Federal Reserve right now.
Absolutely. U.S. stock futures barely moved because Wall Street is just holding its collective breath.
Waiting for the Fed's final interest rate decision of the year.
And the anticipation is sky high for a third consecutive quarter-point rate cut. But it's not just the decision itself.
Right, everyone is obsessing over the signals, specifically the dot plot.
The dot plot, yeah.
So for anyone just catching the headlines, why is this dot plot so critical? Why does it dictate market movements for months?
The dot plot is, well, it's essentially a chart showing where each individual member of the rate-setting committee thinks interest rates will be over the next few years. It's a snapshot of their internal thinking.
A look inside their heads.
Pretty much. And if those dots signal fewer cuts next year than the market is hoping for, you get instant volatility. If it confirms the easing, it fuels the rally.
And we saw some of that optimism already, right, in the U.S. domestic indicators.
We did. The small cap index, the Russell 2000, hit an intraday record high. That's an important psychological marker.
Because it's more focused on the U.S. domestic economy.
Exactly. It's less exposed to global headwinds. When it surges, it suggests capital is flowing into riskier domestic areas in anticipation of a supportive Fed.
Okay, now for some geopolitical headwinds. Former U.S. President Donald Trump is hinting at more tariffs, and India seems to be in his sights.
That's right. He's singled out India for, in his words, dumping rice into the American market.
So, hinting at new tariffs.
Potentially. And the Indian government confirmed they're working on a multi-pronged strategy to mitigate the impact of any potential U.S. tariffs.
What's fascinating is how he connects this specific trade issue to his broader argument about presidential power.
He does. He explicitly warned that if the Supreme Court were to limit his authority to impose tariffs, it would endanger U.S. national security.
So he's arguing that tariffs are a tool of national security.
He argues that the economic leverage from tariffs is essential. So this thread over rice is really part of a much larger long-term legal and political play.
Before we hit our final story, a radical policy shift in Europe. The EU has set a stunningly ambitious climate goal.
Stunning is the word. They agreed to cut emissions by a staggering 90% by 2040 compared to 1990 levels.
That's a massive commitment.
It is. But the fine print is where it gets really interesting for global industry. The policy allows up to 5% of those cuts to be covered by buying foreign carbon credits.
Which means EU industries themselves have to cut their own emissions by at least 85%.
At least 85%. That's going to require unprecedented capital spending and industrial transformation. It affects everything.
That leads us perfectly into our innovation spotlight, a discovery that could reduce one of the biggest costs in the world: fertilizer.
We're talking about self-fertilizing crops. And it's genuinely revolutionary for global agriculture.
So what's the breakthrough?
Scientists have figured out how to convert a plant's natural defensive mechanism, the system that keeps pathogens out, and turn it into a welcome mat for nitrogen-fixing bacteria.
It sounds like flipping a switch with a microscopic tool. How small was the adjustment they needed to make?
Astonishingly small. They targeted a specific defensive receptor on the plant, and by tweaking just 2 amino acids.
Just two?
Just 2. That subtle change was enough to flip the script entirely. The plant started welcoming the beneficial bacteria, which then started feeding it nitrogen. The plant essentially fertilizes itself.
So what does this early success in barley mean for the global food system?
If this can be scaled to major food crops, the implications are, well, tectonic. Farmers could drastically reduce their need for costly, energy-intensive fertilizers.
Which lowers costs across the board.
Immense economic efficiency. And environmentally, it cuts down on chemical runoff. This tiny change in 2 amino acids could fundamentally alter global food security and supply chain costs.
An amazing look at how the high cost of money contrasts with this drive for new efficiency, whether it's trimming bank costs or tweaking a plant's genetics.
It's all connected. The high yields that PFC refused to pay increase the cost of building things. But if that simple 2 amino acid tweak eventually lowers the cost of food, it provides a real biological hedge against that structural inflation.
The battle for stability is being fought in the bond market and in the genetic code.
It always is.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.